All right, well, thank you everyone for joining us for this panel, The Future of Liquid Staking. I guess we're joined with a fair few heavyweights here who've been in crypto not only for a long time, but in DeFi, liquid staking. So let's get straight into it. Starting with Darren, let's go through a round of introductions, not only about yourself, but also your project, moving down the panel.
Cool. So I'm Darren Langley. I'm the general manager of the Rocket Pool core team. So Rocket Pool is a liquid staking protocol. So we're actually a decentralized liquid staking protocol. We're currently the third biggest in Ethereum. We have about 1.3 billion in TVL. And because we're a decentralized and permissionless protocol, we have around 3,200 individual node operators across 133 different locations.
Cool. Seraphim?
Hey, I'm Seraphim. I'm a DeFi expansionist at Lido, so I'm trying to push stake teeth into all the layer 2s, layer 1s out there. Lido is a liquid staking protocol. It's the largest in the space, as you probably know. It's the most liquid, the most mature protocol in the space in terms of liquid staking. So.
I'm Zaki Bunyan, co-founder of Sommelier Finance. Sommelier is a platform for adaptive DeFi strategies. So relevant to sort of the liquid staking conversation, one is Sommelier has turned out to be our most popular strategies with the largest TVL have all been sort of liquid stake ETH yield based. And so we've become the strategies have become a platform for very significant market actors, providing liquidity on ST ETH, leverage staking, making it all accessible. So doing sophisticated things with liquid staking becomes accessible on Sommelier. And then I'm also the author of the liquid staking module that goes live today on the Cosmos Hub, which is taking the Cosmos proof of stake protocol and making it much more friendly to liquid staking, allowing people to immediately convert their staked atom to liquid staked atom. And so it's a big day for liquid staking in general.
Hi everybody, I'm Sriram, founder of the EigenLayer protocol. EigenLayer is a mechanism which allows stakers in Ethereum to provide security to additional services. These services could be new chains, new data availability services, bridges, oracles, secure multi-party computation, machine learning, anything that anybody cares to build on a decentralized network. The idea is already there is a large validation network on Ethereum. Already there is a lot of stake on Ethereum. Why not reuse it for anybody who wants to build systems with decentralized trust? So that's what EigenLayer is.
And I'm Kevin. I'll be your moderator for today. So I spent most of my journey in Web3 with a team called Band Protocol. We were one of the first decentralized Oracle solutions on the market, which meant we had the opportunity to work with not only some OGs in liquid staking, but one of the very first few DeFi projects out there. So let's now look at the here and now of liquid staking. If you have crypto Twitter, you probably saw a showdown photo between Seraphim and Darren. So we'll start off going straight into that. There has been some drama about how much Lido has in terms of staked Ether. In particular, I believe it was around 32, 33%. I'd love to start with Darren. Does this make Lido the bad boy of Ethereum? How do you see this?
I think how we think about it is there are certain thresholds that Ethereum researchers have said are quite dangerous for a staking protocol to kind of breach. One of those thresholds is 33%, and then another one is definitely 66%. So at 33%, you can start to kind of influence the chain in both subtle and sometimes devastating kind of ways. Now, it really does depend on the protocol to a certain degree, but they basically said that no protocol should kind of breach that. So in that essence, it's particularly bad for permissioned node operators because they essentially know each other, right? So because they're a smaller group, they, in theory, and I'm not saying that Lido would do this, but in theory, they could collude and start to do these kind of subtle or devastating effects to Ethereum. And so that's why they've kind of said that you shouldn't. So from our point of view, we've limited ourselves to 22%. Now that's easy for us to say because we're at 3% at the moment. But for us, it was a choice between undermining Ethereum, which is essentially the thing we've built our protocol on, and we rely on it for our sustainability. But also, it's if you undermine that, you don't have anything left. That's for us.
Of course. And Seraphim, your take.
I mean, before we get into how Lido works and what the issue at hand, in this audience, who actually thinks that Lido can impose certain transactions for its node operators on the Ethereum blockchain? You can raise your hand if you think that's the case. Okay, no one's doing it. I mean, at least one or two. Okay, you guys think Lido's great. That's fantastic. But important is to note that what happens is people look at the pie chart of staked Ethereum in the ecosystem, right? And they see 32 or 33% is with Lido. Then goes Coinbase at 8.5, then 4.5 with Binance, Rocket Pool, etc. 28 is not identified. And people are like, oh, 33% Lido, that means they can just do what they want. They could prevent finality from occurring, etc. What's really happening is within Lido, there's 31 node operators at the moment. So if you look at that this way, you actually see tiny slices of 1, 2, 3, 1.5, etc. percent. And in reality, the largest staker in this space is actually Coinbase. Coinbase has 8.5%. The node operators within Lido each has like 1% or something like that. Can Lido impose its will on node operators and say on the protocol level, ban this transaction, ban that transaction in its current form? No, it cannot do that. Can Coinbase or Binance tell its node operators to ban certain transactions? Maybe, right? They're more likely to do so. I can talk about the things that Lido is planning to do in the next few years, basically, that will eliminate the risks that we talk about. But at this moment, the node operators are not beholden by Lido. Lido just pushes the Ethereum into the right pockets and creates a liquid staking protocol to maximize utility. That's it, right?
So it almost sounds like this very well could be a misunderstood milestone of Lido's.
I can see why, because you see again that pie chart with 33% and people freak out. But the reality is a lot more nuanced than that. And within the next year, we're actually going to have community staking, not too dissimilar from Rocket Pool, where you have not 31 node operators, but thousands. So there's going to be, I hope, and that's the big goal, that there's no way you can do anything. It's just the middleware that does its job and has no there will not be an ideology of centralization within Lido at all. It will just not be possible to begin with.
Of course, that makes total sense. And to tie this together, I'd love to get your take on this as well, Zaki.
So I guess I have multiple perspectives on this. So from a sommelier perspective, we just view the sort of emergence and maturing of liquid staking as something that we want to facilitate in as many ways as possible. We think the growth of liquid staking is generally good. Our sort of leading product is somewhat neutral towards different liquid staking providers, but the majority of the capital gets allocated into staked ETH because there are the biggest opportunities. I think one of the biggest challenges is the way the interplay between DeFi and liquid staking does create a bit of a lock-in / network effect. And so you have multiple layers of lock-in in the Ethereum network. You have lock-in at the base layer, which is, it's very difficult once you've staked with Lido to move your ETH somewhere else. Then you have the lock-in effects of, DeFi protocols that, for instance, Aave has hard-coded one staked ETH equals one ETH. Into the lending protocol, which is a sort of level of privilege that other competing protocols don't have. And that allows Sommelier to be more aggressive with our leverage on top of, Sommelier strategists to more aggressively leverage the ETH and maximize their yields when using staked ETH. And so therefore that translates into a larger amount of staked ETH being out there. So market structure is just as much a part of consensus protocols as signatures and peer-to-peer protocols, and that's always been I think one of the biggest challenges for protocol designers.
Sriram?
Yeah, as designer of EigenLayer, we don't have a horse in this race, so we equally support all the different liquid staking protocols. But if I wear the hat of a researcher and a consensus protocol designer, one of the things that I would say is when we're building decentralized permissionless systems, we have to build these systems to be resilient to arbitrary actions at the application layer. We cannot build a protocol today and deploy it and then tomorrow come back and say, hey, you guys should do this or not do this. That's the world that we are trying to move towards, a decentralized, trustless, permissionless world. So how do we internalize these complexities into the consensus protocol? I think that is something that I think about a lot. For example, one of the reasons that we need the decentralization in these protocols, in addition to economic stake, if it's purely economic stake, it doesn't matter whether like $1 billion stake comes from one whale or it comes from 1 million individual units. But decentralization is crucial in Ethereum in order to maintain censorship resistance and inclusion guarantees. So how do we design protocols where actually these guarantees either do not assume decentralization or we actively incentivize decentralization in protocol? That's the two angles that I think we need to consider deeply as protocol designers. And particularly from our own viewpoint as EigenLayer, we are trying to build extra protocol incentives for when people restake, services which want to leverage stake can choose which kinds of node operators they want to allow to restake. And this can create a marketplace where decentralization can be valued and weighted. If decentralization is simply a public good which nobody is willing to pay for, you get exactly what you pay for, which is nothing. If decentralization is actually of value to a service, to a user, then they should be able to solicit and pay for it. That's the EigenLayer view.
I think I completely agree there. And on the topic of protocol design, let's dig into this a little bit more. I think very commonly a thread that we've seen is that with LSDs, there's a value triangle. A value triangle between decentralization, cost, and incentives. Looking at how your protocols are designed, looking at how you've seen other protocols are designed, do you believe in this concept? We'll start from Sriram and we'll come down the panel.
Yeah, like I said, we're not building a restaking protocol, so we're not building a liquid staking protocol. But when you think about these three axes and how it affects what we're doing, I think the thing that I like to think about the most is the angle of decentralization and incentives for decentralization. And today, there is a lot of thinking into how to minimize the incentive to centralization, right? And the best you can do is to make centralized services and decentralized services work very similarly. But actually, I think what we need is active incentivization of decentralization and solicit people who want decentralization to pay for it. So that's really how we are thinking about it. When you're restaking, so how do we enable it? When you go and do a transaction on Ethereum, you cannot go and ask for more decentralized set or less decentralized set. That's not a scope that the Ethereum block space offers. When somebody is building a restaked service on EigenLayer, they can specify very precisely who can opt in to that service. This lets them set the bar for who, which set of nodes they want to actually opt in to run their service, creating an active marketplace for decentralization and tilting all the fundamental incentives towards what people value. That's what at the end of the day should drive the protocols rather than theology, which is where we are today.
Zaki?
So I've been a big fan of natively enabling liquid staking within proof of stake protocols. So that's the work that I've done that's going live today on the Cosmos Hub. It's just a coincidence that it happens to be today. I had almost no control over this. I worked on it for 2 years. It just happens to be going live today. So the idea was that by making it easy for any staker to turn their stake into a liquid stake token voucher that can then be submitted to a LST protocol and turned into staked Atom or QAtom, or we have a variety of different providers on the Cosmos Hub. You get this effect where you are incentivized. Well, it both makes it easy to go from staked Atom to liquid staked Atom, but also provides the protocol features to go from various forms of liquid staked Atom to other forms of liquid staked atoms easily, it creates an interesting sort of game theoretic structure where liquid staking protocol designers, yes, they could put barriers to people being able to leave the protocol to be able to go from their liquids from one to the other, but that also makes the protocols less attractive from a DeFi point of view. It requires them to provide more and incentivize more liquidity on DEXs from the liquid staked asset to the underlying atom asset. So there's like a lot of parameters that you have to play with as a consensus protocol designer to get to what Sriram's talking about, which is a market pace for decentralization.
Yeah, I guess your question was initially about decentralization, right?
The value triangle between
Right.
decentralization, costs, and incentives.
Yeah.
This is a concept.
Yeah, so there's different layers of decentralization you can look at, right? When it comes to liquid staking, just to make sure the audience is still here, how many major LSTs or liquid staking protocols actually have on-chain decentralized governance? 2, 3, 2. I think pretty much just one, really. Lida's one of them. That's the surprising bit. Lida's like the only large protocol. It's one of the few large protocols in the entire space that actually uses on-chain governance, where Lida token holders indeed vote. There's usually a snapshot vote of some sort, and then there's a multi-sig vote implemented, and that's really important because when you have so much value at stake, how can large stakers trust a solution where it's not fully decentralized in that sense? Now, there's obviously issues with the governance at the moment of Lida, which we touched on. I can touch on that later, but in its current form, at least, there is on-chain governance, which is a huge differentiator, right? Second is just a big mentality shift is occurring in certain circles in terms of OSTs. People start talking about institutional-grade solutions like KYC, AML, all that stuff. And quickly on node operators, so that's where Rocket Pool has thousands of them, and that's great. We have 31 at the moment. We want to build them. But we also prioritize a lot jurisdictions. Like you can't have all the 1,000, I don't think that's your case, by the way, but I don't think it's okay when there's 3,000 node operators and they're all in the States, right? Or they're all in the Amazon kind of computing center, right? That defeats the purpose of it. It should be in the States, in Europe, in Japan, in North Africa, etc. And that's kind of what we're pursuing, jurisdictional decentralization as well, rather than just purely 3,000 node operators, but they're all based in Virginia or something. So I don't think it's your case, by the way, anyway, but yeah.
And to tie this one off, Darren?
So I would say, so being a decentralized protocol is a very hard road up the mountain. You have to compete with kind of more centralized competitors who can scale much faster, can deliver things much faster than a decentralized protocol, because we are reliant on node operators bringing their own capital to the table, being economically aligned with our liquid stakers, and kind of having that essentially built-in an insurance fund. But the reason why we take that long road up the mountain is because decentralization gives us characteristics for Ethereum that will eventually make it the open and global financial and non-financial platform that we really want it to be. And so decentralization brings high security, it brings credible neutrality, it brings censorship resistance. At some point when you own your deeds of your house on Ethereum, you really don't want a small number of people being able to deny you access to that. Mm-hmm. So that's why the decentralization is so important, because Ethereum should be an unstoppable kind of open and global platform in which we can deliver all of this fantastic stuff.
And on that, actually, that's exactly where, again, these KYC institutional solutions come in, who are trying to pitch that, we should actually completely gatekeep who's going to put their money in. And if you look at institutionals, the size they operate is so much larger than we have at the moment. There's an actual risk that, like, people are worried about Lida when we are middleware, and BlackRock walks in and just stakes $50 billion and just going to approve one sort of, only OFAC compliant transactions, right? I think I'd be more wary of that than Lido, and people that peddle these solutions, essentially. Obviously, I know the Alluvia people pretty well. They're great and stuff, and they're catering to a specific market. But since we're not in the States, right, we should really be careful about these solutions, right? That's just my opinion, at least.
On the topic of that, looking at a long horizon now, let's look at two major forces in play. Number one, especially a topic of this year, regulatory underpinnings, and two, the Ethereum roadmap. How have these two factors influenced maybe your liquid staking journey so far, but also into the future and beyond? A good person to start from here would be definitely Darren.
Yeah. So the regulatory environment essentially kind of like dampens what we do pretty much on a daily basis. We kind of obviously have to be very, very mindful of it on a everyday basis. Not be too kind of outrageous in terms of being in the market and that sort of thing. So it is something that is kind of on our mind quite a lot. I think it is exciting. Things back in 2018 it was crypto will be dead soon, and today it is now we're actually having the proper fight. So I think that is a much better situation to be in than it was before. In terms of like the Ethereum roadmap is fantastic for decentralized staking protocols. There's a couple of things that will be delivered in the Dankun release that will change the game in terms of decentralized staking protocols. So we're definitely taking advantage of that to be able to kind of scale even further. We've kind of doubled in the last 2 months, but we're kind of like making sure that we can keep that scale coming and kind of make it super efficient for everyone to use.
Amazing. Seraphim?
I guess your main question was about regulatory environment, right? Or
Two major forces in play, looking at, I guess, LSTs, LSDs, regulatory underpinnings, and the Ethereum roadmap.
Right, yeah. Yeah, I mean, on regulatory stuff, it's like, it depends on, is it America or is it everything else? When it comes to the States, they're like, a lot of people are betting on regulatory clarity, which may never come, right? And I don't think you should base your business on it to begin with. Regulatory clarity, regulations in America around staking are basically non-existent. It's a fairy tale, essentially. When you look at other jurisdictions with developed financial markets, actually in APAC, and I think that's the reason we're here in Singapore. If you look at Hong Kong, Singapore, Korea, etc., there's a wide acceptance of the idea of liquid staking. There's plenty of institutions already staking using OSTs, and they're not too afraid of, they don't need product updates or institutionally compatible solutions. Actually, it's pretty much on the rise, which is exactly why I'm here, and not a permissionless, right? America eventually will find its way, and I think it might be a mix of some sort of permission/liquid solutions, but I don't think they're going to take off. The whole point of DeFi is you can exchange value very quickly. That's just my opinion. On Ethereum, we're waiting mostly for I think triggerable exits is an important update, because if we want to implement community staking, we need to make sure like that is on. But yeah, Ethereum has a fantastic roadmap as well. I think we're obviously watching what they do, and it's really important to us. So we're trying to align ourselves as much as possible with what they kind of implement there. So yeah.
Amazing take. Zaki?
From the regulatory point of view, I guess my main perspective is that like we can't plausibly get to a decentralized world by like trying to like hypothesize what regulators will think and then build protocols based on those like hypothetical ideas about like what regulators. It's better to start from like first principles decentralization and first principles economic correctness, and trying to like fight the existence of like liquid staking and delegation is probably not going to be a winning strategy for achieving true decentralization. I think from an Ethereum roadmap point of view, I think like one of the most exciting things is exactly what Seraphim is working on, which is taking representations of like ETH yield and bringing them up into the application layer and into the L2s, into the app chains, where that's what applications will build on. So that's like one of the things that Sommelier is really excited about. You can think of our real yield ETH on our platform as a representation of sort of the best staking yield on ETH L1, best representation of ETH staking yield, and that becomes a primitive that you can compose on top of the application layer. It can be money, it can be collateral, it can be used in like perps protocols, it can be used in all kinds of different places, and I think that's probably like where liquid staking is going to be like the fuel for the fire of driving the sort of multi-chain ETH sort of roadmap.
Sriram?
I have a little bit of a counter take on regulation and liquid staking. So I think of regulation as a proxy for where real-world trust is needed.
Yeah.
Right? Why do we have regulation? We, the people, organize to actually create certain ways to bring real-world trust, as well as, when you're staking, for example, what is it? When you're staking, you're creating a very ultra-limited liability entity where you're basically putting your stake at risk. Whereas when you're operating according to a legal jurisdiction, you're putting a lot more at risk. You take criminal liabilities if you actually break certain things. So one of the problems that we see in liquid staking, the problem that liquid staking is actually solving is actually the trust bottleneck problem. And the cost of trust is actually capital efficiency. And we might see solutions, if we don't actually put these things together correctly, we might see solutions which do not have the protection and backing of legal trust, and neither have the protection and backing of economic self-enforcing trust. We may get the worst of both worlds if we don't actually bring these things together correctly. So I think, there is a role, not for patchwork regulation without understanding the fundamentals of what crypto is actually offering and where real-world trust can be supplanted into the crypto ecosystem. I think delegation is a great place to start thinking about first principles. I'm not optimistic we are going to get there, but it is something that I think about a lot. It's not a crypto maximalist position to say that we've solved all of the world's trust problems, but it is a realist position to say what we can solve internally versus what we need real-world trust to augment things, and where things can become much more efficient, actually augmenting it with real-world trust is better. So that's my position on the first one. On the second one, how Ethereum roadmap interfaces with what we're doing at EigenLayer, we aspire to be the place where the Ethereum roadmap is tested on an opt-in framework. For example, there is on the Ethereum roadmap, one of the most important upgrades over the next 3 years is donk sharding, which is a mechanism to improve data availability. What we're building on EigenLayer, EigenDA, Eigen Data Availability, is actually take the core concepts of donk sharding, the core cryptography and the economic incentives, and build it in a permissionless opt-in manner that Ethereum stakers can opt in and provide hyperscale data availability in the coming months rather than having to necessarily wait for 3 years. But what this does is enable these technologies to be battle tested at a smaller scale before enshrining it into Ethereum. So that's our general framework of thinking is, can we actually be a playground for testing out new ideas before they then get internalized into Ethereum?
I actually really like the point about capital efficiency. I think Seraphim also had notes of this a little earlier in the panel. In terms of capital flow into the industry, it's without a doubt, it's slowed down this year. Year to date, we're about 75-80% from last year. Could there be an opportunity here for more institutional participation in LSTs, LSDs? I'd love to get every single panelist's take on this. We'll start from Sriram for this one.
Yeah, in terms of institutional adoption, I think we are barely getting started. I don't know whether this is the year when we are going to break that door open, but I think it's definitely coming up. In that context, the one thing I want to add is adding to my previous point, which is when major entities want to stake, they want to have assurances which are stronger than I trust you. And I trust you based on what? What jurisdiction are you in? What regulation are you in? This is real. This is the real world, real capital, which is because they're not managing their money, they're managing third parties' money, and they have obligations. Unless it's crypto-economically assured that they're not going to lose their money, they have to lean in on legal liabilities. So I think that is something that we will see. People may opt into their own staking service providers in order to participate in this economy.
Zaki?
So, yeah, absolutely. One of the theses behind Sommelier was that institutions, people like Christy and I, when we created the protocol, what we wanted to do was create an environment in which there is sort of an entity and a set of entities, really, not just like a whole protocol of validators and off-chain compute and strategists who can help protect users who are participating in these systems. So as users go out and seek yield, There's a lot of market complexity that they need to understand, and we found that institutions are, they're sort of very much on the early stage of the learning curve about the liquid staking market, the risks, the like microstructure of the market, when you might be able to exit, when you might be able to enter. And Sommelier has turned out to be like an enormous force for like, there are a lot of family offices that are a number of institutions who are starting to use our protocols because it gives that sort of expert advised structure, but with a high degree of safety and like to sort of participate in this market.
Yeah, I mean, institutions is kind of the reason I'm here, and Lido team is here, amongst other reasons. I heard there's a pool party tonight by Arthur Hayes, so that's another one, but mostly it's institutions, really. There's basically a lot of interest in liquid staking as an asset. In some ways, we're in the educational stage of things, in some ways pretty advanced, where people already do it. I think a lot of people have no idea that actually Franklin Templeton, for example, which is one of the biggest asset managers in the world, built like a tokenized money market, or like that Fidelity actually has crypto custody solutions ready and already working. There's a huge interest in DeFi structured products amongst Fidelity as well, for example, or other guys. So there's already interest. There just needs to be more education, and I think we'll get there. And what they always look for is liquidity. That's what I've noticed, at least.
Maybe this year, maybe next year, or maybe in a few years.
Yeah, we'll see.
Aaron?
We'll see about that.
So liquid staking is tough for institutions. As Seraphin said, they're really still getting their head around that. On the node operator side, though, so Rocket Pool offers liquid staking and node staking. And on the node staking side, there's definitely a lot of interest. That's something that they can quantify. That's something that they can manage themselves or with partners. So we're definitely seeing a lot more on that node operator side of things rather than on the liquid staking thing. We're also kind of seeing it done by proxy, by buying equity in staking businesses and that sort of thing. So I think there's definitely a lot of that stuff happening.
Of course. And that really ties off this session for liquid staking today. I hope everyone here thoroughly enjoyed not only the here and now of liquid staking, but the future and beyond. Big thank you from myself to the audience and also to the panelists for joining us today. Thank you.